In this video, traders, we're going to look at common questions asked about short selling stocks. Stay tuned. Hey traders, warm welcome to you. So short selling, pretty popular thing for us to do as traders. It involves us capitalizing on downside opportunity. We've got long, which is buying in the hope that the stock price is going to go higher. Pretty traditional stuff. We invest in that and we do it trading. We trade on margin. Short selling is selling short, and we'll look at the mechanics of it in a second, with the hope that the price goes low and we can buy back those shares lower and profit from the difference in price that we sold at and the price that we bought at. Right. So what is shorting? Pretty much covered that. It's a case of selling something at a high price. Let's say we sell it at $70, and if we buy it back at $50, we've made $20 on the deal. If we did that with a long position and we bought it at 70, it went to 50 and we sold it, we're going to lose $20 on the deal. It's basically taking advantage, and we'll put it number 2, why short stocks, taking advantage of downside moves. And you would short something if you believe that that was going lower, and it could be a commodity, it could be something else. It's slightly different the way it works with the commodity. If you're trading futures, you're just selling that futures contract. It's a contract you're selling as opposed to stock. Whereas in the stock market, shares are changing hands, and these are actual shares of a company. So it's not a contract, a futures contract or an options contract. It's an actual asset. The certificate, imagine the stock certificate, one share, and you've got, how many of those there are, a million of those, and those are what is changing hands. So if you buy shares in a company, you're buying effectively those certificates, not physically anymore, but that's what you're getting. But if you're going short, how does it work? So let's have a look. And so we've got a guy here who wants to go short. Now, to go short, and actually I've done a whole video on this, so I'm not going to go massive in depth into this, but effectively, if I want to go short, I need to borrow the shares from somebody so that I can sell those shares in the market. So I'm borrowing, if you imagine a big clump of certificates of stock, I'm saying thank you very much. Then I'm going to the market and I'm selling them in the market and I'm getting some money for those. So great, I've got the money. Let's say I've sold $20,000 worth of stock. I've got the money that I still owe that guy the stock. The stock goes lower. I go, oh great, it's gone down. Let's say it's halved. I then buy that same amount of stock back. Imagine we're doing these physical stock certificates now, chunk, and it only cost me $5,000. That's great. I've now got $5,000. I got the stock that I had initially. I give it back to the guy who's loaned it to me. I've made $5,000. Now that guy is going to want to take a little bit of cut from that. He's going to charge me a day rate for borrowing that because it's his stuff, and why should he do it for free? So I have to pay him a little bit of interest. Otherwise, I've made some money. As I say, I've done a video on that going into much more depth, but that's the concept of it. So we borrow shares from somebody, and this is our little certificate here, stock. We borrow those. I could do okay. We borrow those from somebody else, and that's normally like a pension fund or someone who doesn't care about short term. It's like, yeah, you know what? I've got these for the next 20 years. I'm investing. I don't care what it does in the next 6 months, 8 months, whatever it is. I will loan my shares out. So they go out to loan. It creates them a little bit of extra income, right? And the trader borrows it, sells it short, and if he gets it wrong, he has to cover. The guy doesn't care. He gets his stock back. He's got the voting rights to it. Still, everything is still ownership of it. Just loaning it temporarily. So the next question is how do I know if I can borrow shares? That's a great question, because to short sell, you've got to borrow shares mainly. We'll look at that in a second. So most platforms will have an icon that says shortable, can I borrow shares? With interactive brokers, for example, you'll have like a little, you can select a column, it'll be green, it says yes. And then another useful tip is a lot of the brokers will give you a number to say how many shares are available to short. If it's something like Apple, Tesla, the big guys, perhaps not so much Tesla depending on the restrictions, but let's assume something like Microsoft, Apple, it's going to be almost unlimited, the massive shares, because there'll be so many people prepared to loan those shares out. If it's something smaller, maybe something more volatile as well, then that may well be restricted. People might not be lending the shares out to short. Those that have been lent out might already be out there being shorted, and so you're kind of in this thing where it's something you might not always be able to short something you want to short. You've got to be able to borrow the shares. And the other question in putting is, well, why would people loan out their shares to short? Because it's like they're losing money. Well, going back to the initial thing of, if you've got in a fund and you've got a long-term view and you're just investing in the stock because that's your job, you're investing in different stocks, your job is just to get the best return for your clients off the fund. And so if you've got no plans to sell it, you're quite happy to loan that stock out, let people sell it, let people make some money out of short-term moves, whatever they want to do with it, and then you just have it back and you've got a bit of extra cash on it. As long as you're not planning to sell it, you don't think it's going to be detrimental to the stock price over the long term, you don't care. Now, saying that, some people will recall the shares if they see that the stock price is under ambush or whatever it may be. They still have the rights to say, hey, I want those shares back, and give them some notice, and at which point the shorts have got to cover. Okay, when do you have to buy back the shares? I've just answered this question, haven't I? If they are recalled, so they are, like I say, the guy who owns the stock has said, or guy or girl who's owned the stock has said, I want those back. You have to then cover the shares, buy them back in the market with the money that you've got from selling them, whatever that may be, and that could be a loss, and that's bad luck for you, and take those shares and deliver them back. Otherwise, you can buy them for as long as you like. Now, don't forget, you have got a charge that you're paying every day for them, so the longer you hold them short, the more you've got to pay, and that depends on really the supply demand for the stock. If it's a really massive in demand short, you're gonna have to pay a lot. If it's not, you won't have to pay too much. Okay, finally, what's naked short selling? Naked short selling is a manipulative practice that goes on in institutions. You can't do it on a retail basis, where you're selling shares into the market that you do not own. In other words, normally, if you're in a broker and you sell, let's say, 10,000 shares of Apple, there'll be a quick check that says, okay, can we borrow those shares short? Yes, we can. Okay, now allow that guy to sell 10,000 shares of Apple and deduct those 10,000 off the amount of shares to short and allocate it to that guy or that girl trading. But if that isn't in place, and let's say it's just here and you're executing and just selling 10,000 into the market, let's say an institution, and you don't have to check that kind of stuff, that's naked short selling, because you haven't actually got the stuff that you're selling, and you're applying selling pressure for something that's not actually there. You're not borrowing the stock, you're not using it, but you're still manipulating the stock price by adjusting the supply demand for stuff that really isn't there. It's almost fake. So not good, not legal, and has happened in the past. We've had stuff where people have been caught doing that, also been caught heavily losing when they've been naked short selling, and they have been caught out by people recalling all the shares, bids coming out. The Volkswagen Porsche thing was a great example of that. So generally speaking, we're not even anywhere, that's never going to happen to us, or even by accident, because when we're trading with a broker, unless we can get allocated those shares to short, and it's all done automatically, guys, by the way. If you haven't got a position on and you go and sell 10,000 shares of the stock, they'll say rejected due to short sale restriction. We cannot find shares to sell short, or we'll try and locate them for you. It's all automated, and if they can locate it, we'll go through and put it on automatic. You're not involved in any of this process, so it's just a normal thing for us as traders. Anyway, guys, those are 6 common questions we get about short selling. See you in the next one. Take care. Bye bye.